Good afternoon, everyone. Welcome to today's webinar. So we're so excited this afternoon to team up with FCCS Consulting. And we're going to be learning about how co-ops can build and sorry, I'm reading the introduction from yesterday. We're going to learn about captive insurance this afternoon. Thank you so much for joining us. My name is Liz, and I'm here to just run through a few housekeeping items before we get started. So today's webinar is going to run for about an hour, and we will have time for Q&A at the end. We do encourage you to ask questions throughout the webinar. You can just type them in the chat box. Our team will be monitoring that conversation, and we'll do our best to get to as many of those questions as possible during the Q&A session at the end of today's webinar. So to get us started this afternoon, I'm going to hand things over to Brian Clanton. He's president of Farm Credit System Captive Insurance Company, and he is also senior vice president of risk management and insurance at FCCS Consulting. Brian has more than 25 years of experience developing insurance programs for companies ranging from mid-size to really Fortune 500 organizations. So we're so excited we have him this afternoon, and we thank you for being with us. Welcome, Brian. Let's go ahead and get started.
Great, thank you. Is that presentation look okay to everybody? Maybe I'll have you move to the next slide. Just make sure it's formatted okay. Okay, maybe I got my view wrong. Let me put standard on there. Well, welcome to today's discussion on captives. Why are they becoming so common? What makes them unique? Are they right for you? Again, I'm Brian Clanton, president of the Farm Credit System Insurance Company, Harvest Reinsurance Company, and a number of insurance captives. I do want to mention, again, we're going to have time at the end of the presentation to ask and answer questions, collaborate a little bit if anybody has best-in-class stories. If you want to wait and hold on to those questions, or if you want to put them in your chat feature, that's great as well. Yeah, it looks like half of the slide is showing here. I agree, Tamlin.
Sorry about that. I'm working on that on my end.
Okay. So I'm going to have you go to the next slide. Okay. And I'll kind of tell you what the other half looks like here. So let's dive into why are captives becoming so common. There you go. Perfect. Okay.
There we go. Sorry, folks.
Great. To give you some perspective, the number of captives increased in 2020 by 200%. We're expecting that number to be mirrored in 2021, so another 200%. So what's causing businesses to consider self-insurance captive models? Really, the simple answer is cost. Premiums going up. And it's causing business owners, cooperatives, associations, different groups to look at different alternatives so that they can address these alarming rates. It's actually, I've been in the insurance industry for 25 years, as was mentioned, both on the carrier side and the broker side. And as I work with and talk to some of the brokers I've worked with in the past, they're telling me that businesses are experiencing double-digit rate increases, even triple-digit rate increases. And when you continue to have these year over year, it's just not scalable for the business. So it is considered right now the hardest market from an insurance perspective since the 1980s, which was probably the most turbulent time for insurance carriers. We're also seeing that coverage terms are narrowing, and that's something that's not as noticeable to business owners, is that 5 years ago, coverages were more broad than they are today. And what that means is there's more gaps in coverage. We're also seeing certain coverages, limits of insurance are just not even available. I'll tell you, the cyber insurance, if you read the news, cyber's all over the news with ransomware. You're also seeing regulators in different industries are really hammering on cyber preparedness, mitigation efforts. We're also seeing on the insurance carrier side, underwriters are pulling quotes. They're pulling out of markets for different industries. So it's a very turbulent time, I guess, in the insurance industry. Some of the factors that have been driving these costs increase and the turbulence is historically the last so many years we've had low interest rates. Insurance companies are regulated. They need to put the majority of their investments into fixed incomes. They're not getting the return on their investment. I was a executive with a Fortune 500 insurance company about 7 years ago, And our mentality was, let's go buy market share. It was a very soft market at that time. Now you're seeing insurance companies that are having to make up for those lower pricing that they had just even a half dozen years ago. But really the primary reason for these increasing rates is due to claims. The number of catastrophe claims that are occurring over the last 4 to 5 years is historic. I remember when I started in the industry in 1995, the insurance market was still reeling from Hurricane Andrew in 1992. That claim cost $27 billion for insurance carriers. It actually bankrupted State Farm, which was the largest homeowners insurance company at the time. Obviously, State Farm rebounded, but that's how powerful $27 billion was. $27 billion was in claims. 9/11 was $40 billion in insurance claims. 2005, we all thought that was going to be the worst year ever, with Hurricane Katrina, Rita, and William costing insurance companies $130 billion. Well, the last 4 to 5 years with hurricanes, wildfires, different catastrophes, you're seeing that the claims dollars have just been coming one year after another. And it really hit kind of a climax in 2021 with insurance claims being paid over $250 billion. So almost twice as much as that 2005 that we thought was the worst of the worst. And when you look at what it adds up to, it's civil unrest claims, wildfire claims on the West Coast in Colorado where I live. You had hurricanes, believe it or not, we had hurricanes this was one of the worst hurricanes in 2021, or I'm sorry, in 2020. And nobody really talks about that as much because of COVID. And COVID is over $100 billion in claims paid by Lloyd's of London alone. So insurance companies are, I guess in a nutshell, they're trying to figure out how do they get the money back in terms of all those different things, and they're increasing premiums. And what that's causing is business owners needing to become more educated on insurance. You can't just rely on your broker or somebody else, a risk manager anymore. You need to become more educated, and you need to evaluate alternative solutions as well. This time really reminds me of when the ACA was signed into law in March of 2010 for many business owners. Before that time, to be self-insured or have a self-insurance model, you typically needed to have more than 250 enrolled employees. And now it's not uncommon for a business with 50 enrolled employees to examine or have some type of self-insurance model or strategy in place. So what's happening on the P&C side of the business is right on the heels of the benefits that business owners are having to get savvy to figure out how can they control costs. So moving to the next slide, you'll see some of the benefits of managing your own risk within a captive model. Some of these include enhancing your ability to determine retentions or deductibles that better meet your needs versus a traditional insurance company telling you what deductibles are available to you. Flexibility to fund exposures based on your risk appetite. We have property exposures within captives that have sprinkler ceilings, they're in non-combustible buildings. And those business owners choose to take on more of a risk, but they have the flexibility to do that based on their risk appetite. There's an ability to design coverage terms that meet your business needs, which can greatly vary between different industries. And this is a real competitive advantage. One of the things we're going to talk about is an example of the Farm Credit System, which is a banking system, in a little bit, talk about how that has performed and what made it so high performing. But it doesn't matter what industry you're in. If you're in a purchasing cooperative or you're in a retail space, it doesn't matter what industry. There's truly specific risks that could be unique to your industry, and being able to tailor coverage terms is a real competitive advantage. Moving to the next slide, another benefit is having greater control on reducing costs and retaining profitability. If you haven't had a claim this year, and you're with a traditional insurance company, the traditional insurance company will keep that as profit. When you're in a captive, you can have part of that returned as a dividend if you're within a group or cooperative captive. If you're in a single entity or a single parent captive, you're able to take more of that money out, for yourself. So really, your loss experience, if it's favorable, is a real competitive advantage. And the last one I'll mention here is that you have the ability to invest premium payments. So typically, if you invest a premium to the insurance company, and then you're able to invest those premium payments that you kept for yourself within a captive. Also, unpaid claim reserves. This is significant. The tail on claims can be it depends on the line of coverage, but some of them can be 20 years. And the insurance companies will put a reinsurance up there, and so does a captive as well. But if you have a captive, you're still able to invest those dollars, which is significant. Overall, you're able to leverage pre-tax income otherwise not available when paying premiums to a traditional insurance company. Moving on to the next slide. This is just an overview of what a captive looks like, but I'm going to really kind of talk about 4 captives that I'm very familiar with and are the most common. The first one is a single parent captive. This is typically for larger organizations because they are self-insuring themselves through a captive model to a certain extent. The next is a group, a cooperative or association captives. This is primarily what I work with at FCCS. This is when a group comes together of like industry and they create a self-insurance solution that is financially beneficial. The third one you'll see is agency captives. So a lot of times insurance brokers, if they're having a hard time placing coverage due to they don't have the right markets, or maybe the premiums are too high, what they'll do is they'll form a captive. And we work hand in hand with Marsh. They're one of our strategic broker partners as we go into the reinsurance layers. But they've got over 1,000 captives, just them. And it can be good and bad from a broker standpoint. It's bad if you're just moving for the short-term premium because some of those captives will go defunct. But I will tell you that there are some very high-performing agency captives out there as well. The fourth one is a sponsored captive. That's essentially when a third party goes to a single parent or goes to a cooperative and says, let me form a captive for you. And they don't have really a lot of skin in the game, even from a captive management standpoint. They don't have a lot of skin in the game, but those are the 4. All can be highly successful. And I will tell you, 80% of the time, captives are a great solution. As we get into a little bit later in the presentation, there's things that roadblocks you need to avoid, because about 20% statistically of captives, they do disband. They go away. And it's due to a variety of reasons. It could be mergers and acquisitions. It could be due to financial performance. It could be due to a number of items. But if you go into the captive the right way, and I'll give you some of those strategies, it can be very, very successful. And I actually, based on the amount of movement you're seeing towards captives, I think it's going to be like the ACA, that you're going to see more and more and more of that happening. And it's just going to become a norm, from my perspective. And we've been working with captives since 1975 with our organization. So it's interesting what's happened in the last 5 or 10 years. If you move to the next slide, you'll see what kind of insurable risks can be covered by a captive. You'll see that traditionally captives will be leveraged for lines of coverage such as general liability, workers' compensation, auto liability, property, professional liability. The one up until about 3-5 years ago was work comp. Workers' compensation was the most common use for a captive. But now you're seeing that it's actually going into the other side of coverages as well. And it's becoming very, very common. I'll tell you, again, the Farm Credit System captive, which I'll be talking about some of the specifics and how that works. We have 17 lines of coverage that include all of these ones here and more within the captive. And we have a total of 26 lines of coverage. So 17 of the 26 are in the captive, and then we have reinsurance in the commercial market above that. And I'll show you, just having 17 lines of coverage, I'll talk about some of the statistics and in terms of what the savings looks like. And it's jaw-dropping. It's pretty impressive. So moving to the next slide, you'll see the primary difference between a traditional insurer and a captive insurance model. Few that I'll point out: captives are owned by their members versus traditional insurers who provide products to the public. Insurance is a very highly regulated, it's a highly regulated industry. It really is. A lot of reporting, a lot of things that you have to do in terms of financial. But I will tell you, the captives are not regulated nearly to the extent of traditional insurers, which actually lowers costs quite a bit for a captive, and that's a competitive advantage. Captives, if you asked somebody 10 years ago, why are you looking at a captive, they probably would tell you the tax advantages. To me, that's just one of about a dozen things now with everything going on in the market. But captives, they offer tax advantages. They're exempt from state assessments if another insurance company was to go bankrupt. So there's advantages there. Captives give profits back in the form of a dividend, as traditional insurers will keep the profits. And that's why when you form a captive, having an actuarial analysis and being able to set it up for success is so critical, because when those dividends keep coming back every single year and they can be up to 50% of your premium, that's when you know everybody's winning. So that's a huge competitive advantage as well. Captives are actually very attractive to reinsurance carriers, as the captive owners, they have more skin in the game. They're more vested interest in mitigating losses. I travel to our London a few times a year, and then also Bermuda is a huge area for reinsurance as well, for excess layers. And I get much favorable or more favorable pricing from premiums, because they understand the captive has a vested interest in keeping costs or claims down, and it really is a competitive advantage. The last one I'll mention here is traditional insurers. They spread claims to their customers in the form of premiums. But for example, the captives we've run, and I always have to knock on wood, we have not experienced the hurricanes or the wildfire losses, which means we don't have to allocate premium dollars to cover those claims to our members. So really, if you have a pretty solid program in place, it can continue to be a win in many different areas. On the next slide, you'll see additional advantages and disadvantages of a captive. I want to make sure that you understand both, because it isn't the right solution for every business by any means. And that's why doing the analysis, which I'll talk about at the end, is so critical. But the financial benefits, there's many financial benefits. Being able to dictate coverage terms, especially in today's environment, being able to broaden terms when you have an exposure so you don't have a gap, that's an advantage of the captive. The control over your program is a huge advantage. Those are really the three that I think about. I will tell you, from a disadvantage standpoint, there is increased admin. There are higher capital requirements. And, if you have poor claims years, you can have those can be the disadvantages. Now, you actually can put strategies in place to address each one of those. For example, we purchase aggregate claim limits on every line of coverage we have in all of our captives, which means we know worst case scenario, what's the most we're going to pay, and we can limit that to have a conservative risk appetite, which is nice. It really minimizes the concern of shock losses, which when you're self-insuring, that's the one thing you do worry about. So you can mitigate that exposure. Utilizing a captive manager for claims and admin, if you're a large organization, you can build it internally. I see that there's probably benefits to having somebody that does this all day, every day, because the admin with the regulatory authorities, the claims, understanding how do you process all that based on state requirements. That's an easier way, in my opinion, to go about things. But you can, and I have friends that work with companies, and that's their job, is to manage the captive internally. Domiciling of a state, that's actually really important as well, because you can offer different requirements from a capital standpoint. For example, our captives are all primary domiciled in Vermont, Montana, and Colorado. But I will tell you, there's other states that have lower capital requirements as well. Also, Bermuda is a hotbed for captives, and we go to Bermuda quite a bit, and we just haven't pulled that lever because we haven't had to. We have very friendly, insurance-friendly regulators in the states we work, but being in the right domicile is very critical as well. Going to the next slide, I just want to discuss one of our high-performing captives, which is the Farm Credit System Insurance Company. So in the mid-'80s, there was a farming crisis in the U.S. At the same time, the traditional insurance market was also in the hardest market in history. So with loans defaulting, the banks within the Farm Credit System couldn't find D&O coverage. Excuse me. So they were forced to start a captive for this coverage in 1988. I'm going to take a real quick drink here. Sorry about that. So from that time, 17 lines of coverage have been added to the captive out of the 26 total lines of coverage for the Farm Credit System. Of these 17 lines of coverage, some have only $500,000 of primary coverage. Others have higher limits that go up to 10 million, quite honestly. And it's based on the risk appetite of our captive board. So I'll give you an example here with directors and officers, which I mentioned earlier. We have coverage in the captive of $7.5 million of primary coverage. And then we place $330 million of reinsurance in the commercial marketplace above that. So the way it works is you'll have your deductible or your SIR, your retention level. And then you have the captive, which we consider as the working layer, which that's where most of the premium that traditional insurance companies charge is in the working layer. So there's a savings there if you have it billed correctly. And then we go ahead and we purchase the excess layers. And for example, the D&O goes up to 330 million. We have different excess layers on different lines of coverage based on what we feel like the exposure for that industry or for what that cooperative looks like. Some other elements I'll share about this captive. They include, one of the things that's pretty exciting for me on this specific captive is they have a 10-year loss ratio of 24%, which I'll tell you, most traditional insurance companies, if they would be thrilled to have a 70% loss ratio. So what this means is we're able to return 35 to 50% of the premium back each year to the members in the form of a dividend. That's a huge competitive advantage, but it doesn't happen by accident. You have to build the program, intentionally. And we've done that since the mid-80s. Our operating expenses within a captive are at 8%. Traditionally, captives run between about 7 to 11% from an operating expense ratio. When I was on the carrier side, our operating expenses were traditionally between 26 and 33%. So as you can see, that's a real competitive advantage for a captive, that you have lower operating expenses, saves money for the members. Again, coverage terms more broad than what traditional carriers will provide. And then what you find is you have the broad coverage terms within the captive. Many times, 9 out of 10 times, the reinsurers will follow those forms of the captive. So it's a huge win to protect you from shock losses, but then also provide broader coverages for just the risks that are posed to that industry or that cooperative. Investment income, I talked a little bit about this earlier, but investment income is placed in various investment vehicles based on the captive board's risk appetite. We do place in our different captives some of the investments in equities, which has been a win for us, more than what insurance companies traditionally can do. So that's a positive if it's the right fit for the captive board. Traditional insurance companies, so if you go to any insurance company, you can go to AM Best. That's the rating platform, and it'll tell you how their operational and financial performance looks. Less than 1% of captives actually go through the process of being AM Best rated. I'm a big believer that you need to have the internal controls through an enterprise risk management process, but you need to have the external controls as well. So we actually are one of the captive managers that we go through AM Best, and we are evaluated. The great thing is we receive the highest ratings from a financial and operational performance standpoint, but there's SOC audits. I mean, it's going to happen that a Department of Insurance will come in, the regulators will come in and do audits. I actually like those things because it just reinforces who are the good captive managers, and there's a lot out there, but then also who are kind of just trying to get the cost down as low as they can, and they're in it for the short term. Let's see here. One of our entities, which is the Farm Credit System, has not had any wildfires, hurricanes. So that's another competitive advantage, that we don't have to spread those risks spread that premium, because we don't have the risk at this time. And then finally, one of the things I love about the Farm Credit System captive is we go out and benchmark. We actually utilize Marsh to do this. They go out and price our program, the 17 lines and the other 20 and the 26 lines total. If we were to go to the commercial market, what would the premium be? And every single year we come in at 50% premium savings compared to if we just went to the commercial market. That equates to a $35 million annual savings for this Farm Credit System in the captive here, based on leveraging the captive. So the value of this captive, Bill Wilson, who's on the call, probably could think of 3 or 4 other things that I haven't hit, but those are the ones that just really pop out at me. It's a lot of financial, benefits that are significant. But then also the coverage terms, which as an insurance person, I get excited about that because I see when gaps in coverage, equate to losses and what that looks like. So a captive can be tremendous, and this has been a best in class model here. Moving to the next slide, I've included just activities that a captive manager will perform, and it's important that within the operating expense. So for the Farm Credit System captive, that one captive, we have an 8% operating expense ratio. All of these duties and all these activities should be included within that 8% fee. And they include things such as issuing insurance policies to our different members, allocating and collecting premiums. We pay claims. We have a claims team in-house here. We do a significant amount of risk training and consultation. It's interesting, but probably 7 out of 10 discussions, presentations we're doing nowadays revolve around cyber. So that's a huge topic for us from a loss prevention standpoint. We're having a number of conversations. We do a lot of consultation from that standpoint. Investing funds, we do the investments. We secure reinsurance and excess insurance. That's a significant part of our job as well. We maintain the accounting. We maintain the books, the records, all of that. We do the filings for the Department of Insurance. We arrange meetings with a captive board, and then we have to be very transparent with everything that we do. So we do a lot of reporting that way. And the last thing I'll mention is we contract with professional services on behalf of the captive. So for example, we're currently working with an entity named Kroll. It's Kroll. They're one of the best vulnerability cyber testing firms out there. And we provide them, but that's just one example of when we provide different professional services to our members so that they know what they can take advantage of if they want to continue to do, additional loss mitigation. So now that I've explained what a captive is, why you're seeing so much interest in captives, and give you an example of a high performing captive, I'd like to discuss what your next steps would be if you think that an alternative solution makes sense for an association, a cooperative, or even for an individual business. So on the next slide, you'll see that the first step is really conducting a feasibility study. This is critical, and it's got to be done right. I want to be upfront and let you know that there is a cost. Typically, it's between $20,000 to $50,000. It really depends on the entity that does it. It really depends on how many members are you looking at, how many lines of coverages are you looking at that need to be analyzed. But essentially, it's very important from an actuarial analysis standpoint. The feasibility study will nail down what's the probability on these losses happening, what's the probability on this financial performance occurring, and essentially it's setting up all the terms. So I will tell you, one of the things that Bill mentioned is that, so the annual dividend that we provide, so again, that dividend when we're profitable, we're typically about $7 million that we provide annually. I can tell you that we have given back between 35 to 50% of the captive premium. So the captive premium is around 18 to 20 million, and the last year we've hovered about giving $7 million back. We actually are over. There's another aspect called surplus, which as your premiums grow, as your all that investments do well, you have this surplus that's sitting out there. And our surplus is, the regulators tell us we have way too much money in there. And so we're trying to figure out, do we grow the captive limits for this specific captive, or do we give even more of the money back? And it really depends on what the members want. Do they want the premium savings to continue to be lower and lower as the captive builds up, or do they just want their money back, which we can do that as well. So there's a lot of exciting things. And Bill, I appreciate you asking me that question there. But going back to this feasibility study, I personally would not entertain looking at a captive unless you thought it was a long-term strategy. There's a number of captives. Construction captives have gotten a bad rap because construction has been a tough industry to insure. And a number of construction companies have gone to captives that were not well built. And 3 to 5 years later, they go defunct. And that's not what I would look at in a high performing. I think it could be a real value add for an association or a cooperative to offer to their members. But there's got to be that hook that's interesting, enough to to take a peek at it, because there is some work up front from a feasibility standpoint. But the other thing I'll mention about feasibility studies, it'll do more than tell you, is a captive make sense or doesn't make sense, and what kind of money can you be looking at, and what kind of coverage terms, what are all the advantages. But it also can give you an idea where you're exposed, that maybe you didn't realize that you've been exposed in the past from a risk standpoint. So there's a lot of benefits. We do feasibility studies, but we're pretty selective on who we work with, but we've got great partners that we can refer you to. We'd love to give you a second opinion. If you said that FCCS isn't the right, partner for us, we love just, helping people out. So we'd love to send you to who we know is best in class as well. But this feasibility studies, at the end of my presentation, it's a critical part. So again, captives, they're becoming very popular because the market's forcing that, but also captives, if they perform at a high level, they become a no-brainer. I will tell you that that the feasibility study is the first step. The second thing that you need to be prepared for is that different lines of coverage have different tails in terms of claims development. So I'll give you an example. The Farm Credit System started with the directors and officers coverage. That typically has an 8-year claim development tail. So it's not by coincidence, 8 years later in 1996 was the first year we started providing dividends. Whereas property, if property was a line of coverage where it's a pain point and you could find value with a captive, that typically has up to 1 year of claim development tail, where the dividends and those types of things can come back. But overall, very sophisticated. I tried to just give you a kind of a surface level, but I'd love to answer any specific questions if there are any.
Awesome. Thank you so much, Brian. So yeah, we do have some time for questions this afternoon. And folks, if you've had a question during the presentation this afternoon, feel free to pop that into the chat box. We're monitoring that. We have plenty of time to get to your questions. So let's see here. Our first question this afternoon is, what lines of insurance coverage make the most sense for self-insurance captive model?
Yeah, great question. Again, you had the traditional lines that you always saw. Work comp was one that industries would jump to. And then the property, the general liability, the auto, those are your traditional lines. But really what you're seeing now is you're seeing employee benefits from a medical stop loss standpoint, or you're seeing aircraft. I mean, you're seeing pollution. I mean, we've got, like I said, 17 lines of coverage. We probably will continue to add lines as we move forward, just because the feasibility study is dictating that, it makes sense for the different captives that we work with. And if it doesn't make sense, then we'll continue to leverage the commercial markets, to that extent. But it really depends on the industry. It really kind of depends on where your pain points are, where, maybe clients or your members' pain points are. But I can tell you it's kind of no holds barred nowadays with the insurance market and where it's at.
Great, thanks. So this next question is talking about the feasibility study, and in terms of the value for, say, a small consumer co-op who wants to consider a captive. 20,000 is a lot of risk. So the person is asking, is the feasibility study to scale?
Yeah, so that's where I think having individual conversations and talking about, because I have seen feasibility studies that are lower than that. It's typically between that 20 and 50. I will tell you that if you went to Marsh, again, I think the world of Marsh, we partner with Marsh, they're at the higher end. I will tell you there's a lot of really good captive managers that are at the lower end or even a little bit lower. They'll look at specifically what makes sense. I mean, in terms of, let's look at the analysis on how many members, how many lines of coverage. A lot of times you can split up that money and it's not as much, and it's, if you have enough members that are interested. But it really kind of, at that point, becomes a one-on-one conversation. And how do you make it work, and how do you make it beneficial? And we'd be happy to either have that conversation or help, facilitate that with another party.
Awesome. Okay. So another question here. What is the best type of captive to start with?
Well, that's it's funny. It's changing, because if you would have said 10 years ago, it would be the the lines of coverage where you can't find either you can't find coverage, or you can't find the limits of coverage or the coverage terms that you need. I'll give you an example. We our banks out west, they insure a number of vineyards in California that right now cannot find an insurance company that wants to cover them, and they're having to go to the excess market, and they're still having a very difficult time. And these vineyards are high performing businesses. I mean, they really are. So that would be traditionally 10 years ago, what you'd say is, let's build a captive and let's do the analysis and let's build it so that it will be long-term and profitable. But I will tell you, with what the market is doing, and when I mean, a business that got a double-digit rate increase last year and gets another double-digit 25, 35%, which was normal. 25 to 35% was the norm. It's just not sustainable anymore. So it really is, it's really becoming just about anybody, kind of like, you know, with any businesses over 50 enrolled employees on the ACA side. You know, you can't go with the smallest employee or businesses unless you have scale. If you have scale, then you can absolutely do that. But again, that's when you have to start having conversations and then identify, do you want to get into a feasibility study? But the conversations before that feasibility study will help kind of dictate what road you go down. I hope I was clear on that answer.
Yeah, no, that makes sense. Thank you so much. Okay, so going back to our list of questions, got another one here asking what industries or exposures are ideal for the captive model.
Yeah, that's kind of that last question is looking at it. Traditionally 10 years ago, it was what was a tough risk to place. Now it's just becoming, I think, more of where's premium increases dictating a lot of pressure that you have to look at alternative solutions. And the great thing about a captive is it's very, very flexible. It doesn't have to be you take the first 10 million or the first, like I said, we've got some captives out there that take the first 500,000. And you can, and that's just an example. You can build it however you want to build it. And I'm a big believer. I'm not an actuary, but I have a lot of respect for them. They will tell you what your loss experience will look like every 25, 50, 100, and 1,000 years. And they'll tell you with what degree of confidence that they can put around that. So there's a lot of science. It's not a lot of art putting a captive together. It's a ton of science and making sure that it's gonna run the right way.
Awesome. So lots of questions coming in now. So this one is about purchasing cooperatives, and the person asking the question says, you know, purchasing co-ops represent many members, and could a captive be formed that insures all members of the cooperative that it insures all the members of the cooperative that want to participate?
Yeah, so I will tell you, we have, and I have experience in my past life too with captives that have 100% market share within an industry, which is pretty amazing, where they take all comers on. They can't pick and choose like traditional insurance companies. I mean, they take them all in, but it all comes down to the analysis beforehand and making sure that it's going to run correctly. The bad rap on captives, if you ever hear about that, is, well, it ran really good for a couple of years, but then we had a couple of years of bad losses, then everybody left. And that was because it was truly about the premium. It wasn't building it correctly. And you need to have, it's a sophisticated program, but you can build it, and it may not be every line of coverage. If you have an industry where it's different types of businesses come together, and maybe the auto exposures, the exposure you got to put a little more, thought into. I guess what I'm trying to say is you can build it however you want to build it, and those intentions. I enjoy those discussions. I enjoy getting the actuary partners, the outside counsel that we leverage, but different captive managers are going to have the same capabilities to be able to tell you what makes sense and how are you going to. Right now, I mean, if you told any business owner they could cut their premiums in half, they'd probably say, yeah, but it takes a little bit of time depending on those claim development years of that line of coverage. But if you say by this year, premiums are going to start significantly going down, that's a pretty attractive offer from my perspective.
Yeah, great. So just going to another question here. This person is asking about receivable insurance and mentioning that they didn't see that on the list. And they want to know if they can get receivable coverage for a cooperative, and what would be the benefits and risks of that.
Yeah, absolutely. And Insurance, it's, I told somebody earlier today, we were talking about cyber insurance. I said, cyber can mean about 20 different things. It can mean social engineering or ransomware or data breach. I mean, it literally can mean 20 different things. When you talk about insurance and what can you cover, receivables, absolutely. You can put a program together that's very much what you want it to be. Do you want the coverage terms to be, you know, just what traditional insurance companies offer or better? Or do you want to be, you know, what do you want it to look like? But then I'll look at what kind of pricing structure do you want? What kind of benefits down the road do you want? Just very strategic and sophisticated conversations, but that's absolutely, you know, an exposure that can be brought within a captive.
Awesome, great. Okay, so I think we're down to our last question. And again, folks, if you have any more questions, we do still have more time to chat here, so definitely add them to the chat box. But this last question we have here is asking about the pros and cons comparing group active versus 83B. And I apologize, I would rephrase that, but I'm not quite sure what 83B is. So
83B.
Okay.
Is that what you said? 83B?
Yeah, it's comparing group active versus 83B.
Is that the? I'm not really sure. I mean, like I said, the 4 that I've worked with are the single parent. I'm very familiar with that. I've worked with Ford. They have 7 different single parents just for Ford that are highly sophisticated. I worked with a group, which is the cooperative, the association. We formed a number of those. And then also I've been on the broker side. I recently moved over from one of the top brokers to this organization about 1.5 years ago. And I can tell you that, you know, there's some really well done agency as well. And then third party, I don't have as much experience with that, but I'm familiar with them. And I'd love to have a one-on-one conversation. If I could have that individual's name, I can get back to them and provide a better response.
Sounds good. Okay, and I did actually miss one of the questions here. So this is the actual last question. What exit strategies are important to consider for a captive program?
Yeah, I think that's a great question, because I think it's important whenever you look to do something, what is your exit strategy? If the whole world blew up and the actuaries, you know, just didn't anticipate a pandemic, or they didn't anticipate something that was in their analysis. So building the bylaws, putting together those agreements, having the captive board understand who are principal subscribers, what are the rules they have to play by, who are subscribers after that point, what rules do they play by. The exit strategy is critical. Not that you want to go into anything thinking you're going to leave it, but I just am a big believer that you need to have an exit strategy as part of your 5-year strategy. I think, you know, having an exit strategy is very important as well.
All right, well, thank you so much, Brian. This has been super informative. And I want to give you an opportunity for any closing remarks and for any other comments from the audience or questions. We do have a few more minutes here this afternoon.
Yeah, no, so Bill Wilson, who works with FCCS, works with me, has a very strong relationship with NCBA. There's a lot of discussion out there around captives. Quite honestly, from our perspective, we just wanted to come here and educate you a little bit about what is the buzz around captives, why are people and businesses and cooperatives, associations, pooling, you know, groups looking to form this. But really, we want to be a resource for you and just help you out if we can, and we're more than happy to do that. So, you know, leverage us. We'd love to either help you or be a third-party advocate for you as well. So, with that, I want to thank everybody for their time.
Yeah, thank you, Brian, and thank you for the team at FCCS Consulting for taking the time to really share this information with us this afternoon. And we'll be following up with the audience. I should quickly mention that this presentation was recorded, so that recording will be going out to everyone tomorrow afternoon. And then we'll also make an effort to connect the audience with our presenter here for some of those follow-up questions and continuing conversations. So thank you again, Brian. Thank you to our audience for being with us this afternoon. And everybody take care.
Thank you.
I know.